Welcome to another episode of BetOnTCREG. We are here with not only the remarkable, amazing, outstanding Chase Sloan, but today we have a special guest. And our special guest today is none other than Clifton Saunders. Because I know another Saunders, so I know another Saunders. So
Randy don't know.
I say Sanders. I know
I
that.
call him money man, closing man, talk to the money guy. He's the one authorizing the funds, but he's the one and only Clifton Saunders, and I want to make sure that we honor him because he has always came through for us every single time we've asked him to. So he's a man above. He's a legend amongst men. He's the one and only. So I just want to make sure that I gave him his flowers.
Oh,
sure.
Absolutely.
I like flowers.
Hey, we got plenty of flowers to give. And like Randy said, we're here with Cliff Saunders. So give you guys some background. Cliff is one of our preferred partners when it comes to making sure that you guys have the money you need to buy your home. And a lot of times there's so much information out there, Randy and Cliff, that you don't really know if the advice that you're getting is still relevant.
Mm-hmm.
Changes all the time.
Mm-hmm.
Right, and applicable to your actual life. So what we're excited about today is that we're going to, number one, dispel some myths, talk about mindsets, and then answer, the questions that come a lot of times from our clients, from our buyers when it comes to buying their home. So how you feeling, Cliff?
I'm feeling good. I'm excited about this. I love dispelling myths. And I'll tell you the very first myth you dispel is Google is not always right. Don't believe everything you read on the internet. You know, everything that you read online is written by a person who had a specific situation, and that situation is not the same for everybody.
Absolutely.
And so that's one of the biggest things that I see is like, well, I read this and it doesn't go over there. Well, it changes. So don't believe everything on the internet unless you read it from our podcast.
Right.
This is the authentic source for all things real estate, life, and business. And so we're going to make sure that we're giving you guys vetted information from trusted sources, from people that are living this and doing this in today's time, right? Because real estate today in 2024 is not the same real estate that maybe your cousin, your mom.
2014. Yeah,
2014, I bought a house. I wasn't required to do all of that. Like, laws change a lot.
Yeah. One of my favorite things about real estate is the only thing that remains the same is change. Every 6 months, rules change, guidelines change, interest rates change, the economy changes. So what was good a year ago is not necessarily good now.
Yeah.
So that's why you always just have to keep up with it and look at what's going on now. And that's going to give you the true story. And talk to people who are doing the business on a regular basis. They see those changes happening and they can actually, guide you in a lot better direction.
So how does one person apply that? Like knowing that everything is changing and kind of feeling like maybe your mindset is that you missed the boat or it's too late or I missed the opportunity. I could have done it, win it. I should have, could have, did it, right? Like that whole thing.
Hey, the best time to buy real estate was 1,000 years ago. We can't change that, right?
Right.
It goes up every year. And when they think about it, the best time to buy is always now. If you didn't do it back then, hey, don't cry over spilled milk. Get out there, do what you got to do to get into it now. Because still, 20 years from now is the same as someone who bought a house 20 years ago or real estate 20 years ago are feeling those effects because over time, it happens to everybody. Absolutely. And time is key. So the sooner you can get in it, the better it is for you.
And something that I've been thinking about a lot, right? Even, on the way here, I was listening to a podcast and it was talking about the longevity of whatever game you choose to get into. And so something I've even had to learn is that if you're choosing to get into this game, honestly, by staying in it for the long run, you're then going to actually reap what it is that you've sown.
Oh, yeah.
So I think that that's very special that you mentioned that. That's like, you want to still get into the game, whether it's now, so that then you don't have to feel any regret 20 years from now.
Exactly.
So what does that look like then from a long-term perspective? Like, what do you see?
Loan applications
and just even when people approaching, right? Because a lot of times I feel like, Randy, we hear the trends, right? We have our closest ear to the ground because we're actually, in the street, we're walking, we're having the calls, we're having the strategy sessions. So a lot of times we hear the first draft of what people are looking to do.
Right.
I want to buy a duplex. I want to buy a multi-family. I want to
purchase some land.
Yeah. I want to,
I've never bought a house, but I want to buy an investment property first.
But talk about that because there's first of all, how much experience do you have?
Well, I've been doing it now. Actually, we're in February. Actually, this month would be my 19th year in business.
Give it up for 19
Congratulations.
years. Give it up for 19 years.
Congratulations.
Right?
That's
I think
different.
Randy's 19 years old. I don't know.
That's crazy.
I try to look younger than what I am.
We're all just 20-year-olds on that.
For
So,
sure, for sure.
talking about that mindset, because I hear that a lot, right? Well, you should buy an investment property first. You're wasting money if you try to buy your primary residence. What would you say to
Oh,
that?
I'm like, don't buy your primary home first. It's always one of the best things because, first of all, when you get it, you're building credit. So, of course, it makes it easier to get investment properties later. An investor, if you're trying to buy your first investment, now, if you got a lot of money, great. Hey, you inherited some money or you got some money and you want to go put 20% down, 30% down and buy a property. But sometimes just building up that down payment that's required for most investments takes a while. So, what they do is they end up delaying their purchase, which can actually end up costing them more money.
Yeah.
And when you try to buy your first primary home, you can usually get a better deal. You can get better interest rates. Well, if you're ever going to convert it to an investment later, hey, you got a lower payment on it. You can get into it with less down payment. And there's several strategies you can read out there where people will buy their first primary residence. Don't overkill it, right? You don't need to buy the biggest, baddest house around. Buy something small, something that's good for you now, because you know you're going to rent it out, right? And a year later, then you buy another investment, another primary home with the minimum down payment, and then you rent that one out. It's a great way for people that are beginning to invest to be able to acquire properties. Literally, they can acquire property every 12 to 24 months and just grow their portfolio small and do it with very little money out of pocket. Generally, they can buy a primary home each time with just 5% down instead of having to come up with 20%. And so as long as you buy your first and a year later you qualify, you rent that house out and then you put 5% down, you buy another one, and then a year later you buy another primary and you buy 5% down. As long as you're upgrading your home a little bit at a time, don't go from like, hey, I'm going to go 3-bedroom, 2-bath. My next one's going to be a 7-bedroom house. Well, then how are you going to buy something better, right?
Right.
And those don't make good investments neither for rentals for most people. So, hey, buy a small 3-bedroom, 2-bath, and then get another little bit bigger 3-bedroom, 2-bath, and another maybe a 4-bedroom, 2-bath, and just keep growing bigger. And you'll just build it slow. And it's a great way for people to build properties in the short term.
So now, what does that look like? Because you mentioned that if you can put down 5%, is that based off of someone being a W-2 or self-employed?
Same.
Same.
Yeah. It
Just
doesn't
have to make
change
sure, of
like
course.
as long as it's your primary residence, it's 5%. On a conventional loan, most people can get in at 5%. As long as it's a conventional, well, most people are because there's different guidelines for different reasons.
Of course.
You always have to do a conventional because if you want to use your rent from a departing resident, like I want to be able to release out that house to offset my payment where I will qualify for another home. Conventional is the one that allows that the easiest. And so and you're just putting the 5% down as long as, and whether you're self-employed, like you said, it's not about whether you're self-employed or W-2. It's about, hey, can I prove that I make enough money to qualify? If you're self-employed, there's a different route and different documentation than someone who's W-2.
So now, what would that look like if you have not purchased your first home and you still need to purchase that first home, but you're self-employed?
Self-employed, same thing whether you bought a previous home before or you're buying a house now. You're just going to claim your income you make when it comes to self-employed. We're all self-employed. Y'all are self-emploed, right? We all want to make money, right? We want to minimize our taxes, right? So you want to find loopholes. And there's right ways to do that when you're doing write-offs on your tax returns where you pay minimal tax, but you're actually showing that you're making an income. And if you're showing that you're making an income, then you can use that income to buy a house. Now, where a lot of tax professionals, if y'all are watching, stop doing this.
It's tax time. Pay attention.
Tax time. Talk to your tax. It is tax time, right?
It is tax
Talk to your tax guy. And I'll tell you a story of a gentleman I just spoke with yesterday. His tax preparer did something silly that now he can't get qualified, from his advice. And one of the things is that the tax guy, people will say, was, let's just write off everything. Or the ones I hear is, I have a cash business, right?
Right.
So I don't claim it on my tax return. I'm like, you can claim cash on your tax return. If you have a cash business, whatever it is, if I'm mowing lawns, I'm cleaning houses, whatever it might be,
right?
If someone's paying me, I can go to IRS and say, hey, I earn money. I'm willing to pay my fair share, but yet I had expenses and I had this, and here's my net income at the end of the year, and you're going to pay a little bit of tax. But you pay a little bit of tax, right? Now you can qualify for a house. You can qualify for investments. You can buy things, right? You can actually get business loans to expand your business. But when you're that person that writes off everything and it looks like you're losing money, it's bad business for banks. They're just not going to loan to you.
Of course.
And if they do loan to you, they're worse terms, higher interest rates, more costs, things like that. So you want to do it the right way. So there are ways where you can file your taxes and reduce your liabilities, but not cutting yourself out where you won't be able to invest in the future.
So how does a person get ready to and aside from speaking with your realtor, speaking with your lender, how does a person prepare themselves to go through the home buying process? Because a lot of times we'll hear like, "Well, I don't make enough money, right? Like I make 40,000 a year."
There's a limiting belief, you said. We were talking about this, myths and limiting beliefs, right?
Yeah,
Love that one.
definitely.
Yeah. So you hear that, I don't make enough money. Yeah, you do.
Mm.
Yeah, you do.
Yeah, you do to who?
Yeah.
So,
Because
To them.
people be like, "Yeah, you do," and then they get the application and then be like, "Okay, well, no.
Now, where the differences come in, they make enough to afford the house that they're renting, right?
God.
So if I'm going out and I'm renting, and I deal buyers all the time, they're like, "Hey, Cliff, I can only afford $1,000 a month." I'm like, "Great, let's get you qualified to buy a house."
Right.
Now, there's not a lot of options for $1,000 a month,
Mhm.
you know? So what we have to get in their mind is part of the changing their belief system on it is, hey, at $1,000 a month, I'm not going to get a 5-bedroom, 3-bath, 2-car garage. Is that $1,000 a month you're paying for rent getting you that? So you can't expect your home ownership to get you that.
Right.
The big difference is you can get the same, but it's yours.
Right.
So if I'm living in a 2-bedroom, 1-bath house and I'm paying $1,000 a month, well, and that's my max budget. When I go buy a house, I've got to get that in my mind that, yeah, it's going to be mine. I might need to do a little work on it. And it's probably going to be a 2-bedroom, 1-bath house.
So
but
what
it's
would you
mine.
say then to people that, because I think like logically that makes sense. And then again, once we
Emotion
get
gets
in
annoying.
emotionally it doesn't, because once you get in that driver's seat and they get
Mhm.
the pre-approval, yet it's not for the amount that they would have hoped for, it's almost kind of like, I'll just wait.
Yep.
I'm just going to wait till I can earn more, make more, maybe raise my credit score. Is that a valid strategy?
I wouldn't think so. Well, actually, I don't believe in that at all. Because here's the thing. Buy what you can right now.
Right.
Because, okay, so let's say I'm going to wait for my credit score to come up, right?
Mm-hmm.
Or I'm going to save more money. Now, that's my favorite one I get. It's a limiting belief, and let's talk about that. It's a myth. Hey, Cliff, I'm going to save more money over the next 6 to 12 months so I can buy my house.
Mhm.
And then my next question asks them, oh, great. That's I understand that completely, right? How much are you going to save up over the next 12 months? I want to know that number. And most say, well, if I put away and I can save $500 a month, and that's a high one for most people. So $500 a month over the next 12 months.
Mm-hmm.
What is that? $6,000?
Maybe.
Yeah. Now, the average house in Texas has gone up a little higher, but nationwide, 7 to 10%, you're saying.
Right.
So if they're looking at, say, a $200,000 house, a modest $200,000 house, if I waited 12 months to buy that house, at a 7% increase, that's $14,000 it's gone up.
Mhm.
At a 10%, it goes up $20,000. So did it really help you by waiting that 12 months to save $6,000 to end up paying $20,000 more for the house?
I think
the math doesn't check out.
The math doesn't check out. And I think that's such a valid point, because a lot of times we get caught in saying, I need more money to purchase a home. But it's like, if you just actually get clarity on how much money you can afford, like how much you can look to afford right now as far as the home that you're looking to purchase, I think then you're able to actually create more opportunities for yourself.
Yeah. And I think that the moment I said the time that a person needs to look into buying a house is the moment your credit score is high enough.
Yep.
And you can afford the payment that you're trying to get qualified for.
Mm-hmm.
Doesn't matter what it is, if it's a smaller house, and that you have enough for your minimum down payment.
What does that look like?
Like for most first-time buyers, 3%, 3.5%.
What about hidden costs, right? Because we always want to say like a good, better, and best, right? Like if the stars align and the world is perfect, our goal is to get you into a home with no money, right? You see those people all the time, like, my client got money back at closing,
no down payment, no
sounds like a car show, like
how'd you?
And they got paid to buy their house. You hear all that stuff.
Hurry, we're giving away houses here, right? But then they get in the conversation, and it's drastically different. And then there's like this disappointment, like, well, how are all these people getting homes for free? And it's like they never were.
Yep.
Number one, but regardless of any of that, like, how much money do I need to buy a house?
A good rule of thumb is, and I always say, always in a perfect world, if the world is perfect, but we don't always live in a perfect world. And I literally tell my customers that all the time. I said, so my job when I'm getting you ready to buy a house is to not get you expectation of perfect world. We go over what the perfect world scenario is, but then I also want you to know what the worst case scenario is. Now, most people aren't going to be worst case and most people aren't going to be best case. Most people will fall in the middle, And so if you prep for the middle, you're going to be 50% ahead of everybody else for the most part. And I would say good rule of thumb is most first-time buyers in a perfect world, well, they can get in with 3% down.
Okay.
Right. And the average closing cost, that's most people don't think about that. They think about down payment, like how much I got to put down. That's all they ever think about. Right.
Mm-hmm.
But they don't think about closing costs. Like, hey, do I have to pay for insurance for my first year? Do I have an appraisal? Do I have home inspections? Do I have title company expenses, lender expenses, different things like that, different things on properties, flood insurance if it's in a flood zone. All these things can add up. And on an average, you see most closing costs run about 4%, right?
Mm-hmm.
4.5%. If you're a little bit lower score, you might have a little bit more cost. So I would say 4%, 4.5% on the high side. And let's say if they have to go FHA, 3.5% on a high side for down payment instead of 3%.
Right.
So absolute worst case scenario, a good rule of thumb is 8%. So most people lock that number in their brain. Hey, I'm trying to buy a $200,000 house. What's 8% of $200,000? $16,000. If the world doesn't help me with anything, like there's sellers not willing to help with a dime of closing costs, I don't get any down payment assistance, no one's helping me with anything, and I got 16,000, I got 8%, you're ready to go. Now, if you have half that, you should be applying for a house, because at that point in time is where we get the middle of the road. Because sometimes, like we said, in a perfect world, the seller's going to pay my closing cost, right? But you don't know that. You don't know until you go out and negotiate, till you're approved and you're out there looking. But the lender can get you a down payment assistance program or a grant. That covers your down payment and the seller pays your closing costs. And there are some grants that do down payment and closing costs. It's enough to cover it all. So in a perfect world, you can get all that covered. And even in a perfect world, you still need to be prepared with a little bit of money, because we have a customer just 2 days ago, and we got him qualified, and I got him qualified, and he had no money, right? So I put him on a grant program, we got him a grant, and I talked to the realtor, said, look, this customer wants to buy a house, he can afford it, his credit's good enough, but he doesn't have a lot of money, right? So y'all definitely have to get closing costs paid for him. You got to negotiate. And we talked to him about it, but hey, not every seller is going to, so you might lose a house or two. It does happen.
Yeah.
I said, but one of my conversations with him, when I had him, he only had about $300 in his bank account. I'm like, your credit's good enough, you make enough money, but you really need to start saving and budgeting right now. Because what about earnest money? Even if I got the seller to pay your closing costs and got the grant to get it on, to get an executed contract, you still have to have the earnest money, an inspection fee, and appraisal fee in most cases. So a good rule of thumb is don't start looking for a house. Even if you're going to get a grant and closing costs, if you have at least, I'd say 1.5%, is the bare minimum to start the purchase. So if you only got $100 in the bank, save up 1.5. I want to buy a $200,000 house. I need to be prepared to have at least $3,000, even in a perfect world, to get the process started.
And I think it's so important that you say that, because, we talk about preparation, and yet a lot of times we're preparing and don't have clarity, right? So it's like saving money, but you don't know what that target number looks like. And like you said, 1.5%, if the average home in Houston is $320,000, like you said, that's about $5,000 you want to have saved. So we're saying it's tax return time, right? That's a direct use that you can use, the money that you get back from your tax return, or you can save that, let it sit, let it, I'm pretty sure you
can just multiply, make babies.
Right. But you definitely want the money to sit in the account so you can source it and all that different type of stuff. But this is why it's very purposeful when it comes to your budget and when it comes to your savings, because what I like people to understand is that when you're asking a seller for closing costs, it's real money. You're asking them to take $5,000-$10,000 out of the equity that they earned from the home that they bought and give it to you. And then you have to ask yourself, would you do that?
Yeah. That is a common question. I do that a lot. I'm like, let me ask you, I always say, try to put yourself in the seller's shoes. Yeah. If you saved up your money and you put your down payment and you bought it 10 years ago and you maintained that house and you built it up and you saved it up and now you're selling to buy yourself, because you're going to sell that house, you're cashing out. More reasons, a couple reasons they're doing is either they're going to be taking that money to buy another primary home and maybe some of the additional money to invest in their family or invest in another investment property that's going to help them build forward. What makes you think that they're just going to give you all their equity that they saved up and built up towards your house? And I always tell them, would you do that? Would you come off 20 grand and still pay all their closing and stuff like that? There are instances where it does happen, but it's very rare. And so to have that mind, and so part of that is changing their mindset that, yeah, it can happen, but don't get discouraged when it doesn't.
Yeah. And being prepared that, like you said, most buyers do end up submitting an offer on more than one home. It's just because of the nature of the market. There are a lot of buyers in the market. And, Cliff, that's something that I believe you're seeing What are you seeing as regards to people getting off of the fence, rumored interest rate drops? You're the one that looks at the interest. When you guys ask
Every
us what
day.
interest rates are, we ask him. He is the one that deals with the money. We're the one that talks about sales prices.
They find the
So
house, I find the money.
we find the house, he finds the money. So as it relates to the money, you probably have the closest pulse to what's happening in interest rates.
Right.
That conversation, what is it looking like with people coming across your desk?
Well, it's been kind of crazy. The market's been fluctuating a lot. You know, we haven't gotten as many good reports as we thought. I know the Feds had thought that the interest rates we're going to see our first rate drop come March. That's not going to happen anymore.
That's not
inflation hasn't been coming down. But I can tell you this, over the past year, where they were and where they are now, we're in a lot better position, you know. And the interest rates, to me, honestly, don't matter.
Wait, no, but
Ooh.
that's not true.
But why?
Because, you know, when I go on the internet, they say interest rates do matter and that you're a fool for buying a home with interest rates as high as they are now.
Well, that's written by somebody on Google that's never right. True investors, when you have the investor mindset, is if I'm buying this property, well, it's different than like, but it's my house. No, it's still an investment. You're investing in yourself. You're investing in your family. You're investing in yourself. So it is an investment, no matter which way you look at it, whether it's your primary residence or not. And a good thing, a good analogy that I love to use is like, okay, let's talk about interest rates. An interest rate at a 7% on a $300,000 house, right? Difference between a $300,000 house on a 6% interest. I don't have the math exactly, but the payment difference would be about $150 a month, right?
Okay.
Now, I don't think $150 a month is going to make or break anyone, but over a 12-month time frame, $150 a month is how much? $1,800 a year. And it goes back to that mathematical formula. And I'm a very mathematical person. I'm like, if the numbers make sense, it makes sense.
Mm-hmm.
So do I wait a year to get a 6% interest rate on a $300,000 house going up 10% per year? So I could save I would pay $1,800 more in interest,
Of course,
buying it at the 7%. But then a year later, I bought it at the 6%. I would have saved the $1,800 on my interest rate, but now I'm paying $330,000 more for the house, or $30,000 more, 10% higher. That $30,000, last I checked, is more than $1,800, right?
Mm-hmm.
And the good thing is about interest rates dropping, they know they're going to come down. Everybody knows this. There's no doubt in there. It will come down. So let's say even if you waited 2 years to come down, 2 years and the rate finally comes down to 6, well, then you pay $3,600 more,
right,
in interest. But over the 2 years, it's gone up $60,000. The math doesn't check out. It is still always cheaper to buy now, and that's why you see those ones under the marry the house and date the rate. That's been going around, and that is true, you know, because you're locking in your sales price of your house now. But there's a key difference that they're not talking about. Yeah, I may have saved. I'm losing that $1,800. But let's say in 2 years, if I would have bought this house now at $300,000. And 2 years later, it's worth $360,000. Well, I gained $60,000. I lost $3,600. But when I go to refinance that house now, because 2 years later, when I go to refinance it, it now has 20% equity in that house.
right.
And when I refinance it, not only am I getting rid of a lower interest rate, but then I'm also getting rid of my PMI. And 1 year of savings on those two things outweigh the last 2 years of losses on that. So no matter what, when you do the math long term, it will always pan out. The sooner you buy a house, the better. Don't wait on the rates.
So it's really like shifting your mindset to think like an investor.
Mm-hmm.
And so, Cliff, your experience in investing, I guess maybe for your personal portfolio and ways that you have helped people build theirs. You know, if I'm somebody that is like, I want a cash flow to be able to retire on investment properties, right? I'm going to give myself 10 years. What does that look like from practical perspective?
Matters on where they're at. I mean, the sooner someone gets started, the better. Just like any retirement, right? Shouldn't we have all been putting in our 401k since we were 2 years old?
Right.
We'd all be millionaires by now, right?
Right.
But we don't, you know. So it matters on where they're at. Now, some people, if they get started later in life, it might take them a little longer, but they still follow the same process, and that's just buy one at a time.
Yeah.
I would say, how do you eat an elephant? One bite at a time.
Yeah.
You know, how do you walk 1,000 miles? One step at a time. And the same thing with that is buy one at a time. And there's several ways that people can do it. Like my first one is if you're young and you're buying your first property, then what you're going to do is buy the 5% down. A year later, buy another one, put a tenant in there. And eventually you'll start building up homes and somebody else is paying them off. And that's always what the goal is. And we call them doors. Like, how many doors do you
How
want?
many doors?
Yeah.
How many doors you want to own? And whether it's multifamily, if it's a fourplex or if it's a 20 unit, whatever it is, how many doors do you own that's building your wealth and your equity towards, your retirement? And the faster you get those doors up, the better, right?
Of
So
course.
some people, if you start it later, you might not get as much, but not only will you benefit, your children will benefit, your family will benefit. So it is something to do. So if you're a first-time buyer, get out there and buy your first house as soon as possible. A year later, during that first year you're in a home, make sure you're saving up another 5%. Yes, I just put 5% down on 3% down on the first time you buy a house, you get it 3% down. Second time, you got to put 5, right?
Yeah.
Right.
So during that next year, save up your 5%. Be ready to be able to buy your next one a year later, slightly bigger, and just go slowly. Because slow growth is fine. Growth, as long as you're growing,
Yeah.
you're okay. People think that I got to get rich quick. No, man, if I can get rich over 20 years, that's great. It's the same result.
Yeah.
You don't need to be instantaneous. And I think that's where our big mindset for most people is. We're all, I want it now.
Yeah, and there's danger to that.
Yeah, there's danger.
Like, because you get caught up in like the fast flip or the fast way to money, and then it's like you end up with a bigger loss than if you would have just taken the slight yet significant gains, compounded on those.
Yeah.
So let me ask you. So in terms of when you're lending this money, how do people look to then over leverage themselves in terms of getting the first home or getting the second home, or them just not knowing the numbers for what they need to rent the first home at? Like, how do you then notice that? Because even if they're claiming their income on the first rental, is it that they have to still, of course, as you said, wait a year with that tenant in there, or they just have to put the tenant in there, say this is what the rental amount will be, projected income, and then they can go for the second loan?
Now, the way that works is there's a couple ways banks will verify that.
Mhm.
Now, standardly, like say, for instance, I bought my first house. It was 200. Now, I'm going to go up to 250, right? So I'm going to buy my first house, bought it, put my 3% down, and let's say my payment's like 1,800, right? Well, now when a year later, I'm going to buy my next one and I'm going to rent it out and say the average rental in the area. And that's something as a realtor, you're going to look at what is rented over the last 6 to 12 months, similar size, square footage in that area. Now, the way people get over leverage is they don't hire a professional.
Yeah.
Hire a professional.
You're going to pay either way.
Yeah, because you're going to pay and lose money, or you're going to pay a professional, which generally comes out much cheaper and you usually get a better deal. But they're going to be able to leverage it and show you the exact what it will rent for, help you find a good tenant in there and everything else, where now that person's paying it. Typically, whenever you rent it out, the rules for conventional loans, as long as I have a lease agreement and a deposit check from that person, right, starting out, right, then I can count 75% of that rent. So if I rented it for $2,100, I could probably count about, what is that, about 18%, 1,800, which is enough to offset my payment, where now it's considered I'm breaking even. Mm-hmm. Sometimes some people, it comes out a little lower where they're losing $50 a month in the eyes of the lender, even though they're making money.
Right.
But losing $50 a month is not a big deal when you're buying another house and you have your income, because you still, with your income that you're making at your job or your business, you're using that to qualify for the next house. The renter's income is qualifying you on the old house. And now this is where I see the biggest mistake that I see people. So listen closely. And this is the way that a tax preparer just messed up over one of my clients.
Right.
The client left his house in November. Mm-hmm. Right. And he rented his house. He put it up for rent in October, got a tenant for it, got a lease agreement, got the rental for it, and he leased it out in November. And the guy's paid for 4 months now, right? Mm-hmm. Well, when he went to his tax preparer, the tax preparer said, oh, it's only 2 months. You don't need to claim the rental on your tax return. Man. So it's not a big deal. Yeah, it's not a big deal. But what is tax after you? If I would have claimed the, say, $2,000 a month rent for November and December, $4,000, and then I have to pay my payment and everything else, in the end, I might have profited $200. What's taxes on a couple $100?
Yeah.
In the eyes of him, it's not that big a deal. But to a bank,
to a lender,
to a lender, since it was rented in the prior year and you've now filed your tax returns and you claimed you rented it last year, but it's not showing on your tax return, I can no longer count rental on that house. You can show me a lease agreement, you can show me deposits, wire transfers, everything, but you did not claim it on your tax return. We don't care.
And I think people forget about that everything is connected. You cannot tell the tax preparer, also known as Uncle Sam, I didn't make no money. I don't have any money. And then turn around and go to the lender and say, I have all this money. Look at this money. They talk to each other. All the systems, my mom used to say, we're in a digital technical world. That's why they find y'all, because everything's connected.
Yeah, and even if they don't talk together, you got to think about this though. The government is involved in everything, like you said.
Yeah.
They write the rules for mortgages. They're with Fannie Mae, Freddie Mac, FHA, VA loans. They're all government and conventional. They're entwined. And they're writing a thing saying, yeah, we want to make sure you have the ability to repay. Well, how do we prove that you can pay for the mortgage or someone else is paying for your home? That's what the federal taxes were like. Well, we already have something for that. People have to claim their income. So how are you not going to claim it, but then come to their other entity and say, we do make that money?
Right.
Then you're basically telling them you're lying on paper. Where if most people don't get audited, so that's why these tax preparers do that.
Yeah.
Because it may never come up, and it never comes up. But if it ever does, you're gonna owe some penalty in taxes. They're not gonna break your kneecaps or anything like that, but they will break your bank account.
Yeah, it will. And I think you even shared with me, the coin phrase is that they become liar loans. Trying to change your tax return to qualify for a home. So if that same example, that borrower says, well, I'll just go back and change my tax return and then add the income. I mean, is that a solution or?
Well, partially. Now, what happens is, let's talk about that scenario. So if you have people out there who've already filed their taxes and you did them wrong, is there hope for you? Yes, there is. All right. So there is some hope. All right. So just kind of keep that in mind. Now, what it is that there are liar loans. So they're not going to allow you to just go change your tax return, right, and then go buy a house immediately.
Yeah.
You normally have to change your tax return, file it, pay what taxes you owe on it, make sure it's all legit. And then typically the rule of thumb that a lot of banks have is if you went to change it just to buy the house, you're a liar. Now, if I went and filed my taxes and edited it, and then their rule on it is kind of like 120 days after you file your taxes, then you apply for a mortgage. So if you messed up, you better go fix it now. Yeah. Call us in June.
Yeah.
Because you got to fix it 4 months later. Now you have your filed tax returns, you have your amended tax returns, a letter of explanation on what happened. My tax preparer forgot to write my rental income for those 2 months on there. So we fixed that. 4 months in June. Oh, a bank will allow it. They're like, okay, well, you did your part. It's not like you were trying to buy a house today and you changed it today.
Yeah.
You're now messed up. You're stopping yourself from buying for several months in that case. Now, there are some banks who won't take it at all. It is a tricky situation where a lot of places where like, no, you said that's it. That's all we're going to count.
That's what we're going to count.
Now, if it's within reason, now I wouldn't imagine if you went back and amended your tax return and showed that you had 5 properties that you didn't have on there to try and show income and all that other stuff. They're not going to believe that. Yeah. It still has to make sense, and that would make sense. Like this gentleman, the same thing I told him. I said, look, if you're going to try and buy a house this year, you need to go back to your tax preparer, make them fix it, file your amendment, get it, and then call me in a few months.
I like that.
And I think like one of the biggest things too that you had mentioned is kind of like you want to, of course, do your taxes right, but then it goes back to choosing wise counsel, because a lot of times you hear I'm gonna do my taxes on my own, and then you start doing your taxes on your own, and then you find out this is not what I expected it to be. Yeah. And so I think that's also a testament to why wise counsel is important and choosing your circle wisely. Yeah. As you continue to build and scale whatever you want it to look like.
Yeah.
So even with that, Randy, a lot of times when we talk about one of the benefits, I believe when you do work with us is that we have a network of vetted people, and not always that's not always the case from a borrower's perspective, right? They're just getting started, so they don't know what they don't know. So a few things about choosing a lender. Number one, how do you go about making sure you're with a reputable, valid lender? And then the second part of that is, what's the difference between a mortgage broker and a loan officer?
Okay, that's a good one. Now, a couple things is, you have a good lender if he's bald.
Because y'all be stressing him out.
That means he's working hard for you out there.
Sure.
So he's working hard. But I would say you want to look for experience is good. And even reviews are good. Look for people who have good reviews, have experience, that've worked with a lot of customers. Because if they do have a lot of reviews, that means they've worked with a lot of customers, right? And, so anyone can be great one time, someone who's great thousands of times, you know that they know what they're doing. So a reputation is good to have. You know, go on there and look at it, read the reviews, and you don't always have to believe everything. Always read everything with a grain of salt. But you can actually look up loan officers and online and see how long they've been licensed.
Yeah.
You know, where they've been at, what their tenure is. So you can look that. Everything's on Google for that and internet. But just make sure that they understand and know what they're doing. Have good reviews is the best thing, right? And of course, a good referral is, you know, if they work good with somebody else, you know, and they know somebody, great. Warm referral is always great. Now, once you get that warm referral, still do your vetting. Do they have good reviews? Do they look good? Everything else they've been doing the business a long time. And I would generally think that most of the time, if you're talking to lenders, most of them, you can tell who knows what they're doing for the most part, because mortgages are very complicated. There's a lot of stuff. You throw a couple different scenarios at them and they don't know how to answer it. That kind of tells you their experience is a little low.
Yeah.
But that's the biggest thing I would say. Just look at their tenure, look at their history, look at their reviews, see how many clients they've worked with, and make your decision from there. And that's how you find a good lender.
And are there any like questions proactively as a borrower that I should be asking? Like, okay, great. I saw you on Google. I follow you on Instagram. You look real great. Your head's bald. You sounds like you know what you're talking about. But how can I be a diligent borrower, right? Like asking the questions. What are the questions that people are not asking when buying a home that they should be asking to make sure that they feel confident about their investment?
Oh, and it's more about them more than anything. Have you worked with buyers like me before? I'm a first-time home buyer. I'm an investor. Well, do you do a lot of investor loans? Tell me about all your investment programs. If you work with a lot of first-time home buyers, do you work a lot of first-time buyers? That means you should know all the programs, right? So that's kind of just checking their history, how they know. Because I can't say I'm a first-time home buyer lender that I do this, and then they call me, what about all the programs? Oh, I don't know any. We don't offer any. That's a kind of a clue. Or if an investor calls me up and I do a lot of investing, well, great. I invest as well. I know all the investment programs. You know, they should know their products that they're selling well. And so based on your category, hey, when it comes to them, hey, this is where my credit score is. This is my situation. Have you helped other people like this? And they should be able to tell you how they helped them. And when you hear their stories, that's going to tell you, oh, they know what they're talking about. So that's a good thing right there. And I would say good questions you want to ask them. And the one I get a lot is, what's your rate? That rate don't matter. You know, and you will see lenders across the board. That's all they do is they try to entice you with the lowest possible rate in the world, right? And it ain't that far off than anybody else. But if their service is horrible, you never get in your house to try to get that unicorn rate. Is a whole nother story, right?
It's usually the one question that people ask.
That's the first thing. What's the interest rates? The average interest rate is posted on the internet. If the average rate is 7 and he's telling you you're 7.1, don't think he's lying to you, because you might be a little bit above the average based on credit score and debt ratio. If he tells you you're 6.9, hey, you're a little bit below because you got really good scores. The average rate's there. So most people now, I would say, if you go online and you look at the interest rate and the average rate on the market is 7%, and this guy's telling you 10, there's a problem.
There's a problem.
There's a problem. You know, so just that's the only time you should have to look at rate is something like that.
And I think it's also like, you know, something that we like to say is that there's multiple parts within the deal. And so whoever you choose or who you put in place can make or break the deal. Doesn't hands down. And so also something that you mentioned in regards to whether it was a certain type of loans or interest rates, but what would you say are a few reasons why investors don't get approved for, say, if it's a DSCR loan?
Oh, that's an easy one. Now, an investor, if you got approved, I always say there are the 3 things we talked about before, you know, CIA, credit, income, and assets, right? Now, on a DSCR loan for an investor, it's just credit. Is your credit score high enough?
Right.
And assets, right? Do you have enough money for down payment in your reserves? There is no income because no income is required except for one factor. And this is where the realtors come in. I had a person who was buying an investment property, and his realtor said he can help him. He was, you know, he knew what he was doing and everything else. And one of the first things I tell him is, all right, he's going to be putting 20% down as a DSCR loan. And when I ran the payment on the house, the payment, I think it came to like $1,700. I'm like, what's the rental rate? And the buyer's asked me, I'm like, I don't know. That's a question you got to ask your realtor. Will it rent out enough to cover the mortgage payment?
And does it need to rent out for the full mortgage payment, or can they say, well, I'll just pay the difference?
Oh yeah, that's what happens. There are a couple different DSCR loans like you brought up. And if anybody's watching, what is a DSCR? It's a debt service coverage ratio loan. It's a loan that so long as the rental income that you're going to be pulling in on the house is enough to cover the payment, that's enough to approve the loan, right? And so after I run the numbers on a house and I say the payment's going to be $1,718, And then I talk to the realtor, and the realtor says, oh, well, the average rental's $1,700. Well, we're $18 short.
Yeah.
Right.
We've got to break that. And I've had one. Now, there are some DSRs that allow you to go a little bit below, right?
Mhm.
And sometimes if they're higher, they'll give you a little bit better rate. So there is some issues below, and there are some DSCRs that they don't care as long as you.
And are they required for the 20%?
Yeah, like one of them I did, he was a foreign national, and it had to hit that thing. So what I do? You got to put $3,000 more down.
Yeah.
I have to
So
get
it's
the
a math
payment
equation.
below 1,700.
So it's still a math
Yeah,
equation.
it's still a math equation. He's $18 over. How do we cover that? Hey, let me call the insurance agent and see if I can get the insurance a little cheaper. Save $10 there. Now I'm $8 over. Now you got to put $2,000 more down
Right.
to get the payment there, and that solves the deal. Now, when you're off, but I had another one where I was off by $200. The realtor told me it was going to rent for this much, and it came in $200 less.
Oh man.
It was a big difference, and that's a huge difference on rentals.
When you say when it comes in, so because y'all not gonna tag me, add me, talking about so I'm gonna ask these questions that y'all got. So is the 20? Number one, the minimum that you need on a DSCR loan is the 20%
20%.
down, and any differences from that rental, you're gonna have to be able to put
Put it
more
down.
down, so that way the numbers make sense. And when you say that the rental numbers came back different from what the realtor
The
provided,
$200 less. Yeah.
what are you guys what are you vetting that against? What came back?
Well, the appraiser. Now, we always have y'all run y'all's rental comps. Just like when you list a house, right? You're going to run your comparable sales, what it would rent for, what it would sell for. So I'm relying on you before the customer pays $700 for an appraisal,
Yeah.
right? So now the appraiser is going to do the official one. He's going to go out there and do an appraisal, tell us what the value of the home is,
Mhm.
and he's going to tell us what the average rental rate is for that home.
Mhm.
And if that amount that the appraiser put on there doesn't match,
Yeah.
then we have something to go over. But I was like, now, just like anything else, if it comes in low, because appraisers, we don't have any control of that, the realtors can rebuttal it. Like, well, no, my numbers are right. It should have been 1,900, not 1,700. Here's the rental comps to justify it. We send it to the appraiser and we get it adjusted.
Yeah.
So you can still do that. But there are ways, like an example on that one, I had to have them put an extra 5% down because there's a different client that they did allow no DSCR where I didn't have to prove the rent if they were putting 25% down instead of 20%.
Yeah.
So some people can do it it doesn't matter with the rent. And ones like that are great for people who want to buy a beach house.
Yeah.
You know, so if you're going to go buy a beach house and I'm going to Airbnb it, well, you're going to make much more money, right? Airbnb in it, but you might have to put 25 to 30% down where there's no DSCR because a normal rental on a house like say for in Galveston isn't going to be $4,000 a month, but that's what your payment is. You're only going to make enough money to rent it out Airbnb, but what the rentals are
lease.
on a standard 1-year lease, people
Yeah.
don't pay that much for it. You know, they
I
buy for
understand.
comfort and other things. So that's where you'll more run into the problems on stuff like destination homes and stuff like that, where you have to put a little bit more down.
So speaking about like beach homes, we have a lot of second-time home buyers, right? They did the job. We shouting you out. You got your first home and everything like that. They were trying to figure out like, okay, now what? What should I do with all this equity that I have in my house? Because everybody's saying that I'm sitting on top of diamonds, but logistically I just don't. I'm paralyzed and I don't know what to do. And I may not even really want to sell. So as a second-time home buyer, what are your options
Okay.
to getting into another home?
Well, there's a couple ways. Now, if they have the money saved, great. You know, if you're not going to tap your equity in your home, that means you can't use it. If you're not going to pull it out. Now, there's a couple ways. You could sell your house and then use that money and go buy your primary home and then take the difference and then go buy an investment. Some people do that, right?
Okay.
Some people can do a cash out on their home. Like say I've got $100,000 in equity in my house. I might pull out that $100,000 and then use that to go put 20% down or 30% down on a couple investment properties.
Okay.
Then there are some people that, what if you got $200,000 down in equity in your house? Well, I might pull it all out and then I can use that money to buy a house cash, you know?
Okay.
So there's a lot of different ways, but it does require you to pull money from your equity. And I've had people go both ways. I've had a couple customers close last month that they cashed out of their house. And I had one young lady in Galveston, she cashed out, she pulled out $250,000 out of her equity. She had a lot of equity in her house. And they used that money and they already went and bought another investment property cash.
What do I need to know about a cash out loan? If
Okay.
since I'm not, because like the fear, sometimes we'll hear fear because it's like, oh, I don't know what about both payments, right? Like, I don't want to sell my house because it's a good investment. I have all this equity, but it's like, the thought of 2 mortgage payments scares me. And isn't my original mortgage payment going to go up if I borrow more? So what is that?
Yeah, it is a valid concern. And I'll give you an example. Same thing with this young lady. She's like, well, I didn't have a mortgage, right? And I pulled out this equity. Now I have a mortgage. Oh my God, what am I going to do? Well, I looked at your debt ratio. They can afford a mortgage, right? Because you're not going to be able to get a loan unless you can afford it, right? Because we have to look at it. So I think it's more their limiting belief that they can't. Well, they could afford it. But what are they doing with the money? The whole reason you pulled it out was to invest.
Right.
Yeah.
And an investment should be bringing you money. So if she
Not
went and
to
got
buy a baby Benz.
exactly, don't go to Vegas on it and lose it overnight. Then yeah, then you got a problem, But she went and already bought another investment property, and with that investment property, it's going to rent, and the rental on that is going to be more than what her payment is on her new mortgage.
Yeah.
So she's cash flowing already, and now she has another paid off house now, and it's not about necessarily the cash flow. Now she's got 2 houses, and how much do they go up per year?
About 10%.
7 to 10,
7
right?
to 10%.
So the more properties you have, you see your values rising. So that's why it's important to buy, because now she has that property that's gaining value. Her original home she kept is gaining value, and she's getting cash flow from that other property. And so, and some people, the 2 mortgages is not a scary thing either. Like sometimes it's not always 2 mortgages. Sometimes when you do a cash out, they just give you 1 new loan and they pay off your old loan and you have 1 payment. So it's the same as anything else, but you pulled out money. So I do get that too. They're like, I pulled out money. Why is my payment going up? What did you think?
You pulled out
What do you
money.
think was going to happen? You got to apply some common sense to them. So I'm telling them, talk to a professional, use common sense. If I'm pulling out $100,000, it's going to cost me something. But will that money that I'm pulling out benefit me and my family in another way?
Right.
Can I invest it? Will that investment bring me money that's going to offset that? And if it does, it has nothing to be scared about.
And I think that also goes back to almost like a sense of leverage too. But you have to make sure the math equation makes sense.
Yeah.
But how are you able to leverage your first property to then purchase a second one and then build and build and build?
Yeah.
You know?
And whenever we're talking about our primary home, and like I said, I had another customer, same way. I got them approved. Their house was paid off. And I got them approved to pull out cash, and they would have enough money to buy another house cash. They were scared. Emotion gets in their way. They're like, no, they had enough money. They have enough money to put 20% down on another house, right? But technically, an investment property, the rates are a little bit higher, and you're having to put the 20% down. On a primary home, the rates are lower. And they're giving me all the money. I can go buy it cash, and I can get a better deal if I'm buying it cash. But they didn't want to leverage their home. They're worried. So they're like, I've got my 20%. I'm just going to use that and go buy another house. Great. If that's your comfort level, that you're afraid to use your current home, but you have the means to do it another way, do it what makes you most comfortable.
Yeah.
But me being a mathematical person, take emotion out of it. When I write down the paper, like, what is it going to cost me? How much is it going to bring in? Am I profiting? Is it going to make sense? If that math equation works out, go for it.
I love that.
And it goes back to kind of something that actually Gary Keller mentioned on a video call we were watching. And he said that it's like creating your own models. Because what you stated is that because it is a math equation, you created your own model and said, okay, then this is what I'm going to look to do because the numbers make sense. And I think a reoccurring theme that we hear when we're talking to clients, or whether it's talking to people who have $500 million in real estate development, they say you got to be very, careful with your buy box, and what is it that you're looking to purchase. So if the deal makes sense, it's not about emotion anymore. It's about making a decision.
Taking action.
Yeah.
So we got a few questions
Sure.
that we promised that we would bring to the lender. So the first question is, I have inherited a home. What's the best method, or where should I look to find qualified resources to explore ways to leverage the asset to achieve my goal in having at least $7,000 in residential income monthly? So they've inherited a home. What qualified resources should they be looking at to leverage the asset to build cash flow?
They're looking at you.
Get you a
I
professional.
didn't even pay him to say that.
I mean, that's basically it. Now, as far as inheritance goes, it's whether you inherited it, someone gave it to you, you bought it. It's your house. That's all that matters. You own a house.
Yeah.
Right?
You own a house. Yeah.
How much equity is in it? Now, if the house is paid off, well, then you got equity. It matters what it's worth. Now you have that equity. It's your house. So long as you qualify for a loan, you can pull out that equity. You can sell that house instead of pulling out the equity, and then now take that cash to go buy another investment that might be, because if you inherited, maybe you didn't like that area, you don't want that zone, well, sell it and go buy something in an area that you want to invest in. But if you like that house and you want to keep it as an investment, then cash it out. Pull that money out and then use it to buy another one. And I think we've talked about this in previous talks before. This is a great analogy if it's an investment house that you don't live in and it's paid off. And if you got equity in it, that's where the BRRRR method comes in. And that's one of my favorite methods for people who have cash, who have equity in a house. And so write it down. I'll say it out real quick. BRRRR is buy it, right? Rehab it, right? Rent it, right? And then refinance it and then repeat. Right. So that's what the BRRRR is. And so they can just buy. Yeah. It's like cold, but your money, your bank account's going to be very warm because you're making money. Right. You're buying that house. You bought it already, which you got it. Inheritance is the buying. So in yours, the inheritance is the buying. Right. Now it's got equity in it. You cash that bad boy out. You rent. Now you go buy another property cash. Right. And then as soon as you get, now you've already got a tenant in that one. So the first thing you should be doing on that one though is making sure it's renovated, right? Make sure it looks good. Let's rent that one out so you get cash flow on it.
Yes.
Right? Now it's cash flowing before you go get another loan. Because you're worried about, well, Cliff, I got to pay a new loan if I go get a loan on this. Well, let's make sure this one's already rented. You're already making money on it. You got a good cash flow on it now. And then whatever amount that rent is, you want to pull out enough cash out of that where the payment is being paid by that tenant. And then you're going to take that cash and go buy another property. And you're going to fix it up, put a tenant in that one. And once it's rented and it's doing well, then you're going to cash that one out and repeat. And you can do that every 12 months about.
Randy, you talk about this a lot with 1031 exchanges. How does that play a role into... are those two different things?
Two completely different things. Like a 1031 exchange, like for instance, is I'm selling that house. Now, if she got that as an inheritance and it wasn't her primary home, if she was to sell that house right now, she's going to pay capital gains tax on it.
Exactly.
Right? Yeah. But cash outs, loans are non-taxable, 100%. She could pull out that 200 grand and not owe Uncle Sam a dime. Now that whole 200,000, she can go and invest in another property, as an example. So
you're saying that she took a loan. So technically, what you're saying is that she took a loan against the property, correct? So she still owns the property, but she still has to pay back that loan on whatever that she took.
Yeah,
but now she has the cash.
But she still has the cash.
Still paying a mortgage.
So now she has. But either way, though, that's like. Excuse me. That's like getting funding, essentially. So now it's seed capital.
Tax-free funding.
Tax-free capital.
And that's why, I even think I was thinking something about like Elon Musk or something. He doesn't really pay himself salary. He just takes stocks and other things, right? One of the things he does is he borrows money against his stocks because guess what? You don't pay tax on borrowed money. You're just borrowing your money and your business is paying it and you're doing it. You don't pay tax on borrowed money. So you can literally just borrow that money as long as you only pay the tax when you sell it.
So are the qualifications the same for cash out?
Yeah, same thing. You go to the same thing.
The same as when you buy your home, credit, income, assets.
No different. Like buying a house, getting a cash out, getting a HELOC, buying an invest. Everything's the same. Do you make enough money, right? Is your credit score good enough? So credit's king. You got to take good care of your credit.
What's good?
Good credit, I would say, minimum most people need is a 620. Good credit is like 680, at least the national average, I think, is 685 or 690. But good credit is considered at 720. But good enough to start buying a house, 620 is your ideal goal.
You can get it done with 620.
Oh, yeah. And 620 is not considered high by any means. And it ain't hard to get a 620 score.
Yeah. So the second question is, are there any tips on how to increase your home's equity? Is it better to do a cash out refi or HELOC to put a down payment on an investment property? So are there any tips to increase your home's equity? And is it better to do a cash out refi or a HELOC to put a down payment on an investment property?
I'm going to answer the second one. I'm going to let you answer the first one, right? Equity, right? What do they have to do to make their house more valuable? What would you say?
I'd say fix it.
Yes.
The stuff that's not working, definitely you want to start there, and you want to add value. So you want to add value to the room. So whether it's in the kitchen, the bathrooms, you want to add a bathroom. If you're adding space, something I think people don't always think about is that upgrades are not added value. Yeah. Right? So just because you I repainted and I got these beautiful baseboards, that's beautiful to the person that is going to buy the home. And you might be in direct competition with your neighbor who has not done those things. Yeah. However, adding a bathroom, for example, is going to add more value. Adding a room, adding more square footage is going to be what actually adds value to your home. And then, like I said, the overall maintenance. So the roof, upgrading the, appliances,
The
not,
patios.
like I
Yeah.
said,
And don't
payments.
go over crazy. Like I always say, one of my favorite analogies is don't put gold toilets in there. You think you spent $100,000 on a toilet?
Yeah.
It's going to bring up your house $100,000? It's not.
Yeah, because we even used to talk about that with just, we renovate and sell properties. And my mentor would always say, don't over improve the home because the home still has to comp.
Right.
Right. So you don't want to go in and buy this house and the neighborhood's selling for 300,000 and now you've put enough money to where it's a $500,000 home. You're now the highest home in the neighborhood, and nobody can bring your values up.
Nope.
So you want to make sure that if you're looking at what do I improve or what do I renovate to add value, take a look at the competition. Your realtor is going to be able to help you do that. You can see, okay, so what do these homes have that I don't have? So that way you're competitive.
Yep. So as I said, fix up the property, make sure it looks good. Make it, I always say what makes it, make it compelling.
Mhm.
Compelling is one of my favorite words. Make it compelling. Make it look pretty. Make it look nice, is good, and bring it about. Kitchens, bathrooms, more square footage, that does it. Now, the second question she had was, what's better, a HELOC and or a cash out? Now, I'll tell you the two differences. Now, most people don't know the differences between the two. They hear them. A HELOC stands for a home equity line of credit, right?
Mhm.
Where it's basically kind of like a credit card secured against your house.
Mhm.
A cash out is, and that's the one that's a second loan. So like if you're getting a HELOC, that's when you have two mortgages. Because I have my original mortgage, right? I have my original mortgage, and then I have my new HELOC mortgage. So I have my payment on my original with my escrow and everything, and I have my HELOC as my second one. And now when you get a cash out, whatever your original mortgage was, they just increase the amount and they give you the cash difference, but they pay off the first one and they give you one big loan for that amount.
It's kind of like a blanket.
Yeah, it's like it just pays off the other one and gives you a brand new one. And it's a first lien loan. All cash outs are a first lien loan where they're less risky to banks and you'll usually get a better interest rate, right? A HELOC is a second lien loan. That means if you stop paying that HELOC, they normally won't foreclose on you until that first one is paid off. Because if they were to foreclose, they would have to pay off the first lien. So that's more risky for a HELOC. And that's why you generally will see a higher interest rates on HELOC loans compared to a cash out loan. Now, what makes one more better than the other? Now, it matters and now this is where the math comes in, mathematically. I had a customer call me yesterday. Same thing. I get these calls all the time. They're like, hey, Cliff, I only want to borrow $20,000. I'm like, well, how much do you owe on your house? Because a HELOC. Do I do a $20,000 and pull out $20,000 on top? Well, he got his loan 3 years ago when we helped him buy his house, and he had like a 3.25% interest rate.
Mhm.
So do I pay off his old loan at $200,000 to pull out an extra $20,000 and give him a $220,000 loan at like 6.8?
Mm-hmm.
That's kind of silly, right?
Yeah.
Because now his original loan that was $200,000, he's now also getting that higher rate. I told him, no, your best bet is a HELOC. And the reason is because you keep that original loan at $200,000 at a 3% rate, even though a cash out might be a 6.8. If he's getting a HELOC and it's a 7.8 or an 8, it's only on the 20,000. So it's much smaller. So when you do the blended average between the two payments, it comes out much cheaper. Now, a reason to do a cash out. Let's say I had a cash out or I want to get a cash out, but the customer only owes $30,000 on a house and he's got a 3% and he doesn't want to lose it. But he's trying to borrow $200,000.
Yeah.
So do I go get a $200,000 HELOC at 8%? Or do I just go ahead and get a $230,000 on a cash out at a 6.8? The blended average comes out less.
Right.
So it just matters on it. Most of the time I say if you're going to be pulling out more money than what you currently owe on a house, a cash out will be better. If you're pulling out a smaller amount than what your current house is and it has a lower interest rate, then the HELOC is better.
And both of those is just very important that the HELOC can foreclose on your home.
Oh yeah, it is. You got to remember, you're getting a lien. You don't pay it, they will come to collect eventually. And I've seen this one happen. I've seen this happen before where a customer did not pay his second lien for years, and they don't charge it off. They just stop trying to collect. But that lien is on that house, and the minute he paid off that first lien, 15 years later. He tried to sell it and he couldn't. And then this bank was going to come back and try and foreclose on him now. Because now, if they foreclosed on him, and he only owed him like $15,000, I'm like, dude, you better go get a personal. And you can't get a loan now because then you go to a bank and say, hey, I'm trying to refinance this. And they're going to be like, okay, well, what liens you got? Oh, that's a mortgage lien. Can you show me your payment history? Oh, I haven't paid it. Default.
Yeah.
They're not going to loan to you. So literally, I was like, you're going to lose your house if you don't pay them. And he didn't have the money. I said, well, you better go get a personal loan.
Yeah.
You better get a personal loan real quick and go pay that HELOC because you don't want to lose all your equity you have in a house. You better figure it out and come up with that money. But I couldn't get him a mortgage. Credit wasn't good. He had a loan in default.
Yeah.
He didn't qualify for a mortgage.
You're still asking somebody to borrow money, and I know we got just a little bit of time. You talked about second liens. One of the reasons why I believe it is important in partnering with a realtor is because they are going to be able to look at any kind of lien, second liens. Title companies will be able to pull any second liens. We see that with down payment programs.
Oh, yeah.
Some of these down payment programs are not free money.
Oh, no.
Can you speak to that, wisdom to that? Because a lot of people, everybody wants it, right? That is fair enough. But what do they need to know?
Well, there are down payment programs, and I love down payments. Like I said, I help a lot of first-time buyers. There are different types of down payment programs. There's ones that you do have to pay back, and there's some that you don't have to pay back. Now, why would you get one that you have to pay back? If that's the only way you can get into a house right now, we talked, the sooner you get into a house, the better. So if I have to go get a grant for, like, I'll give you an example, TSHAC is a Texas program, right? Mm-hmm. And it gives you a 3-year deferred grant. You can get up to like 4 or 5%. But they give you a little bit higher interest rate, and the money, you have to keep the house for 3 years. Mm-hmm. Well, that one's a temporary one. Well, as long as they make their money back a little bit by giving you a higher rate, but I got into my house now. Mm-hmm. 3 years later, the loan is forgiven. It falls off. I no longer have to pay it. Now I can refinance to a lower interest rate and have a cheaper payment. Mm-hmm. So that's a good thing. If I didn't have the down payment of my own, it was, hey, that's a great way to get into a house. Mm-hmm. Now, there are some, like the TDHCA, the Texas Department of Housing and Community Affairs, they have another grant where they give it to you, and it's a 30-year grant. They give you the down payment, and they give you a lower interest rate, but no matter what, when you sell that house, you have to pay that money back.
Right.
So it's just a temporary loan. Now, most of them are zero interest. They don't charge you interest on it, but if they gave you $10,000, when you sell that house or refinance that house, you have to pay it back.
It's going to come out of your net proceeds.
Or 30 years later, they say, or 30 years. So if you get the 30-year loan and you pay it off at the 30 years, it's due and you have to pay it off. But you have to pay it back. So that's why you'll see some of those on there. The TDHCA is the ones I see a lot because a lot of people sometimes will want to take the lower rate one because they can buy more house, which is okay. Because sometimes with a higher rate, their qualification goes down. They take the lower rate one that they have to pay back whenever they sell the house. It's not a big deal. They got into a house. It's still like, it's kind of like saying, and that's where you see some lenders where they advertise 100% financing.
Right.
Because, hey, you're getting an FHA loan 3.5% down, and then I'm getting your grant paid. Well, that's 100% financing. Yeah, right. We're not giving you the money, but eventually you're going to have to pay it back. So it's the same thing as if you bought the house with zero down. You borrowed $200,000. Hey, if $10,000 came from TSHAC, I borrowed $190 from the bank and $10,000 from them. I still borrowed $200,000. And so that's why you'll see those second liens. But if that is a way to get you into a house, you take it. So there's some people who are like, oh, I don't want to use it because I don't want to have to pay it back. Why? Is it an investment? If I bought that house now in that program, right, and eventually I got to pay it back 5 years later, 10 years later, how much is that house worth?
It'll pay itself.
It pays itself.
No.
So,
and I think that's always smart. And I think that, people just have to make informed decisions with wherever they're at. So start where you're at and just move from there.
Exactly. And make it, don't always make it about emotion. It's mathematical.
It's logical.
If it makes logical, mathematical, if it makes sense to you and your family, do it. Yeah. Get into your house as soon as possible. Get your family into a house, because I can tell you what, like I said, I always say one of my personal stories is when I get into it, it's like I'm my first person in my family to ever own a home. Mm-hmm. Now all my family members own home. And I can't imagine, my mom rented for my entire life, and we lived in apartments and we moved a lot and things like that. She never had her own place. And I'm thinking, over the 30 years, how much money did she pay in rent? How many houses did she pay off for somebody else?
Right.
Wow. Yeah.
And the places and the schools we had to go to is always different. Like me, I bought a house early on in life when I was 20 years old. And I've always owned my house since I was 20. And so, like, my kids all grew up in houses and things like that.
That's all they know.
Different mentality. And they act different. They are different. And they have a bigger perceptions of the world and things like that, because you want. And I always think, and I'm buying more houses now.
Yeah.
And the reason is because they just get more expensive. And I'm thinking about investment for my children or my children's children. I want to start investing now, whether I'm going to reap the benefit or not. They will.
They will.
So even if you start late, the sooner you start, you could be 60 years old to start buying houses. Hey, and you're leaving it to your kids that are 40 and 50 and your grandkids, whatever it is. But the sooner you start, the better.
Absolutely.
Solid.
We definitely trust that you guys have felt like this conversation has added value. Real estate is a math problem. That is the good news. And so, of course, Cliff, we want to thank you so much just for blessing the set, placing your bet. Randy, you have any closing words for the people?
Let's get to work.
A man, a few words. We'll see you guys next week.
Let's get to work.